Yeah, I'll throw this up on YouTube. Hold on, is that recording? Try it again. Pause. Okay, I think we're recording. Cool, guys. Yeah, let's start at it. You guys can start shooting questions away, and we can kind of go through whatever here. Today was actually a really good day that I decided to sleep in. I see. I took the second trade you've got marked, but cut it at 1.4 R. Oh, why, man? If you so let's see.
In the
You go
second
back
trade,
to
can you hear me?
your 4 hour. If you look what we're doing, we're putting in lower lows, right? And if we've made two, chances are we're going to make a third. Chances are we're going to keep going. You just keep shorting till it doesn't give you the option to anymore. So just looking at the way the 15 price formed. So what I mean is, look how aggressive this move down was. And then I think you can't hear when somebody talks. Huh. Okay. Hold on a sec, guys. Let's try to figure this out here. Mute. Speaker, headset. Hold on, let's try this. Somebody say something?
Yeah, can you hear me?
Yeah, I can hear you guys now. Can you still hear me?
Yeah, I mean, I thought you just didn't hear me at first. So
No,
basically,
sorry.
yeah,
Go ahead, man.
it's fine. So before you started explaining, I just wanted to ask you, this trade that you took, do you take like this downward move? Do you take partials on it, or was it just like a straight you moving your stop loss into profit as you went down? What was my question?
So I didn't trade today. I just marked these out that I was going to send for the group. I slept in, but I'm going to show you the way I manage here. Okay. Perfect. So let's say, so the way I manage trades is like this. Let's see. So if we go back to these, so I usually leave my stops open, and what I do is when my trade hits 4R, I'll partial out 20% of my total position size, so that if it comes back and hits my stop loss, I pretty much break even. Like I might lose a little bit of commissions or whatever, but for the most part, I break even. And what I found with doing it this way is if price comes back and tests one more time, I stay in the trade. Whereas if I go break even, a lot of times it'll come take me out, and then it'll continue on going. But I do have an exception to this rule. So if my stops are a pip and a half to 2.5 pips, I break even this way. But let's say my stop was like 4 pips, 4.5 pips, which probably won't ever happen. But let's say it was, and it takes me this long to break even. So right here, so it would take me 18 pips to break even. There is no way in hell I would be holding risk for 18 pips. So on something like this, hold on, let's see. So say we get into that kind of scenario, soon as this price went down, soon as we broke a couple of lows and took out a couple of little mini demands, like I would automatically do something like this. So if my stop loss is too big, I would put it, somewhere in here. And as price goes down, then I'll trail the stop loss. So whatever way you gotta take risk off the market as quick as you can, just do it that way. But yeah, to answer your question, as long as the stops are small, we partial out at 4R. Another one of my buddies partials out at 3R, but he sells like 35% of his trade. And well, however, you got to break even, but that only makes sense if your stops are smaller than 2.5 pips and you can be risk off in 10 pips. If you got to wait 15, 20 pips, then you better break even. As soon as you break a demand or something, I would break even, because if price comes back, then does the market really want to move price back down, right? And even if it
Yeah,
takes you
yeah.
out, do you trade seconds at all?
No, no. I'm literally. I just started out trading order blocks, and I'm sticking just to the 4 hour and 15 minutes. But the thing is, what I learned from interacting with the Phantom community is what I thought was the right way was to do it through order blocks. So the way that I, at least from my understanding of partials, the way that you guys do it is taking taking partials on order blocks. So
Yeah,
yeah.
so I don't know who that is, but please mute yourself. Hold on. Is it that person? Okay, so I just muted everybody. I think you can unmute yourself again when you got to speak. So like what I said to you, if you partial out here at 4R, at this point, you hold your trade to where it's got to go. So our first target would be this low right here. So myself, I would probably do something like this. When we get to TP1, I would partial out 50 or 60% of my trade, maybe 70 or 80. And then the next target would obviously be off the next time frame, in which case we expect expectational order flow to continue. Well, how does that work? Well, that usually means we run this low and generally we'll see some sort of a pullback. Obviously, being it's Friday, you'll most likely close out the majority of your position here and not hold risk. Like depending, it's all up to you. Like myself, with a small stop, I would probably hold right to here. If you're worried about securing profits, then you just simply drag this down. You know, if it moves down 5-6 pips, move it down another pip and lock in your profit. I've been kind of testing the trailing system myself right now, and I found that you seem to make more money taking a couple of losses and leaving it open and holding the majority of your position. And again, that's totally up to you guys.
Yeah, got you. Thanks. Thanks.
Yeah, well, test it out for yourself, see how it works. Like a lot of people won't break even this way, and they literally just break even after it goes to whatever, after it breaks a demand. Like say this demand gets broken, right away you go break even. Next demand gets broken, put your stop up here. And then as demands keep breaking down, you just keep dragging your stop loss, and that's the idea. And then if it did spike up, you protect yourself. That's like I said, I'm testing it right now and I haven't found that it makes more money, but what it does do is it avoids you from getting a bunch of red on your account, which helps your psychology. Because
Oh, I
like,
see.
because like, I don't know about you guys, but like if I lose a penny in the market and I see that red on my screen, it bothers me. Like lose a $20 bill, no big deal. You lose 2 cents in the market and then suddenly it affects your head, right?
Yeah.
So that's totally up to you. They both work. They both have their advantage. Yeah, however you want to do it.
And sorry to bother you again, but like when it comes to your entries, you take them only 1 minute, correct?
1 minute or second. So this right here, this right here, I'll be honest with you guys, I would have taken this loss had I taken this. I'm really bad for doing shit like this and not covering the high wick like you're supposed to. So what I do is I would do something like this, where I would probably take that loss, and then I would probably look on the 15 second and be like, okay, well, where's the next demand that we create? The next demand that we create would be right here, this little guy. So as soon as that breaks, okay, well, where did that break come from? Okay, well, that break came from something in here. So I would jump back in on the seconds there after I take this loss, because I still believe that this is going down because 4-hour order flow is bullish. And what I was saying in the beginning was, if you guys notice how this stacked very slow, very everything got mitigated. And as soon as you see this, you got to ask your question, why? Why did they stack everything? Why was everything mitigated? Well, there's only one reason. We're taking buy side liquidity going up, so that when this happens right here, my first thought would be we have a V-shaped recovery and there's no buy side liquidity left whatsoever, meaning the whole top got wiped. So if all the buy side liquidity is gone and you see a V-shaped recovery like this, demands start breaking, what's likely to happen? Well, we're likely to seek out sell side liquidity. Well, where is the sell side liquidity? And this is everything stacked down here. But as soon as you see everything mitigated like that, that is put there to be run quick. So if you see how easily price came through here, price didn't have to bounce back and retract every time it hit an OB, because for the most part, everything's mitigated, right? So I look at how aggressive price is. How long did it take to do this? How many pips did we move in that time? Okay, well, how long did it take to do this? And how many pips did we move in that time? And that's that can always be a determining factor of the true move. Usually, if we're going to be aggressive to the upside, it's not going to look like this. This is liquidity stacking. If that kind of makes sense.
Yeah, it does. It does. Yeah.
Yeah. And for myself too. So if I'm gonna start going counter trend, I like to see one of these aggressive reactions, V-shaped recovery. If I don't get one, I'll probably wait for a 15 chalk to complete, which was down here. But if I get one of these, as soon as 2 1-minute demands break, I'm okay with entering. And,
yeah, so that's a very good point that you just mentioned. So you want to get into a 15-minute order block first, and then you wait for the break on either the 1 minute or the seconds. Is that correct? For you to enter.
So right now your 15 trend is bullish here, right?
Yeah,
You're breaking highs, but you also know that you're bearish on the 4-hour. So what I do is I pull a fib on the last leg down, and this blue line is premium. Once we've gone above that premium, anywhere above that, it's safe to start looking for sells. So that's kind of how I price myself. So if the top forms correctly like this and you get an aggressive reaction, it's really easy to be like, okay, well, the BFIs are getting involved. I feel safe about entering on this. If you want some more confluence, we look at the 15. Well, you get a bearish engulfing candle on the 15. That's also more confluence. If you're still not sure and you don't want to enter here, you wait for the 15 chalk to complete, and that's your safer entry. But and then obviously your 15-second entries are in here, but you don't need those to be profitable. I just myself, sometimes if I want more confluence or if I want to try to get in with a tighter stop, I'll go on the 15 seconds, but there will be times where I'll take 2-3 hits on the 15 seconds and the fourth one goes. So there is a bit of a disadvantage to that sometimes, but that's the nature of trading, right?
Yeah, it is. But would you recommend, like, for somebody who's still not like familiar with the system, would you recommend only staying with the 1 minute?
I would not go below 1 minute if I were you. When I first started using the seconds, I started taking more losses than ever because I wasn't using them correctly. Now I use the seconds way different. I use it as extra confirmation. I don't just enter on every 15-second break. So in this case, by the time I enter on the seconds, we've already broken the third demand. So this 15-second entry is actually safer than the 1 minute entry, right?
Yeah. So you're entering basically on a third break of on the 15-second chart, so that like you get the confluence through breaking multiple structure levels, not just one. Is that how you do it?
Correct. But it's got to align with your higher time narrative. So in this case, our 4-hour is bearish. We've gone into premium. Once we've tapped premium, I don't have a problem with selling. Whereas if we started just breaking one demand or two demands right here, I would probably be leery of selling. And in that case, we'd wait for the 15 chalk to complete. Just like if we didn't get an aggressive reaction like this and the top formed really flat and there was like 20 candles up here, I would wait for a 15 chalk to complete, because this is our first confluence, is the V-shaped recovery. If you don't get that aggressive reaction, I'd be looking for more. But like I said, in this case, you get the aggressive reaction, you get the 15 close, it's there. If you look, most of the time, the market will show you. Obviously, in real time, we all miss a lot of stuff. But in the case of euro, if the move's true, it usually gives you another chance or two to get in. It's not like the pound pairs where if you missed your chance, you sit out the session a lot of times, right?
Yeah. Like, how do you even backtest these concepts? Because like on TradingView, it doesn't let you go through the seconds, like whenever you're like deep into the 4-hour charts. Or do you,
Uh,
the only way to test is through the demo?
so the easiest way is probably get soft forex. It's it's an MT4 program, and I forget, I think it's like $70 or something for lifetime. And it does it basically lets you back test as far back as you want, and it lets you download data from like 5-10 years ago if you want it. The downside is you're trading on MT4 and it takes you like an hour to do a session because everything's so slow to draw. So if you're back testing yourself, it's a great system. If you want to back test with a group, I found it to be quite a pain in the ass. But I would recommend soft forex. It's soft, the number 4, and then X. I think that might be the company name actually. But look that up, and then you just hook it up to your MT4. And like I said, you can download any data for any pair, whether it's Bitcoin or whether it's Euro from 2008 you want to test. And I've gone back and tested these concepts like way back in the day, and they seem to work at all across the board. Euro, it seems to work on the best, and I think part of that is because it's the heaviest volume, right? But that would be my recommendation to you. But if you want to test it just on TradingView, I would like mark out your 4-hour zones, mark out your 15 zones, and then just switch between the 15 and 1 minute. And if you do a split screen, you can actually do bar replay on 15-minute and 1 minute at the same time. You just have to fast forward at the same time. So like if you bar replay this, you'll want to keep your 15 minutes behind this so it doesn't show you what happens in the future, right?
Yeah.
It's annoying. It's very annoying for the amount TradingView costs. Like I think the premium's like $60 a month or something. There should be a lot more options and a lot more data than we get.
True.
But yeah, no.
I'll look into it. Thank you.
Yeah. Does anyone else have any questions?
Hey
Actually,
Rob, how you doing?
There are people in the chat. If you
Oh,
want to
wow.
look at questions, yeah, ask in the chat.
Hey Rob, can you hear me?
yeah, I can hear you. What's up, bro?
Right. Yeah. First of all, thanks for holding this Q&A. I know I teased you a couple of times on Instagram.
Yeah.
So basically, is it possible if I can share my screen?
Yeah, hold on. Let's well, I'll come back to everybody's questions in a second here. Let's see. New share. No, not that. Hold on. If I stop share right now, does it let you share right now?
No.
Hold on. What about now?
Yeah, I can share my screen now. Yeah.
Cool.
So can you see my screen?
Yeah, I see it.
So basically, my question was, I took this trade yesterday, but I'm a little confused with the concept of liquidity. Like I understand there's like equal highs, equal lows, and like price needs liquidity in order to move, in order to feel the movement. But for example, let's say price taps into this buy side liquidity. How does this liquidity like affect price?
What do you mean?
Like if price taps into this liquidity, like what happens to price? Like because in Phantom to teach us how.
Generally, liquidity is absolutely everywhere. Like I used to draw absolutely everywhere because it is everywhere on the charts. But liquidity is just your fuel to move, right? Don't really know how to explain it easier than that, but anywhere you look in the market, there is liquidity. This is where I start pulling the fib on the 15 and the 4-hour and see where I am in the leg to see how far I think the retraction should go before it comes down. 3 or 4 out of 5 times you'll be on the right side of the market. Sometimes you're just on the wrong side. But yeah, if you're not sure, the easiest thing to do is mark out your 15-minute zones and wait for a couple of breaks. So if you're counter trend, you could wait for a 15 chop to complete. Or if you get a V-shaped recovery, like I said, just a couple of demands breaking would be enough to enter. Okay. I'm not sure I totally get your question, but like liquidity is basically just required to keep moving down.
because okay, I understand mitigation and cost, but for example, like liquidity, we know like if it taps into this side of the liquidity, it'll go in like the opposite direction. But like, why does price do that? Like, I know there's orders sitting here, so when price hits, like enters that area, the orders gets filled, right?
Right. So hold on. Where's my annotate? Yeah, I'm not very computer literate, guys. Give me a sec here. Nope, that's not it. Basically, your whole range needs to get wiped before price makes its move, is what it comes to.
Okay. Because
Yeah,
right here yesterday when price tapped into like the 4-hour demand zone, like there was liquidity stacked right here and it wiped it out. And
yeah,
there's like a V-shaped recovery, and I was looking to enter here, but I missed this entry, so I was looking for like a change of character and a supply to like the flip. And but the
yeah.
issue was when it came here, I didn't know which candlestick to choose and where to put my stop because there's like so many wicks here.
Yeah, so the smart thing would be to cover your long wick. I'm kind of a retard that way. I would have probably just covered the first couple wicks and taken a loss on that. I was actually looking at that, and there was a very clean entry on the 15-second to get back in too. But yeah, anytime you get a range like that, if you're not short, cover the low wick. And a lot of the times it'll keep you from taking that loss. Myself, I'd rather take the loss and get back in than take a smaller position size, but that's just how I trade.
Because the thing is that because the issue was if I entered here, my stop loss would be too big and the risk reward wouldn't be attractive. So I was like, where should I enter? Because the 1 minute wasn't that clear because you have like all these wicks right here, and I was looking at this wick,
Yeah.
but like it took me out there. So if I put my stop loss here, the risk reward wouldn't be attractive.
No, it wouldn't be as attractive. And do you trade seconds at all or just 1 minute?
No, just 1 minute. I just find 1 minute more like suitable for my trading plan.
Yeah, just stick with that. Honestly, dude, the best thing I can tell you is cover the low wick.
Okay.
That's the best advice I can give you. And don't feel bad for taking that loss because I'm the same as you. I would probably cover the first couple wicks and take that loss. And that's just one of those things, like 7 out of 10 times that'll go. The other 3 times it's going to come test that low wick.
Yeah. Okay.
How much would you recommend, like for us, like what's the minimum that you would personally recommend go for in terms of RR? Because I still haven't started trading with the system. I'm still back testing, demo trading, but I notice also like the wicks, when you cover them, it's not an attractive RR. So what's your personal recommendation for the minimum RR that we should go for?
If I don't get minimum 4R, I won't enter the trade, and preferably 5R if you can. And that's what I was saying earlier. For those of you guys that are at the beginning of the call, like if I end up having a trade like 4.5 or 5 pips stops, I don't wait till 4R to break even. I'll start trailing my stop loss because I like to have risk off the market as quick as possible. So that's where I started using seconds more. Again, I don't recommend it if you haven't got more profitable on the 1 minute. But the time frames, it's the same across the board as long as you have a higher time frame narrative, right? So can I just share my screen actually, and I'll show you. Let's see. You just stop sharing for a sec, buddy, and I'm gonna share, and I'm gonna talk about that trade you lost yesterday.
Okay.
And let's see, where are we? Everybody see my screen?
Yeah.
Okay, perfect. And so where was that? Oh, right. So I had this marked out. So this would have been your initial loss here. So show you what I do. And again, if you don't use seconds, you probably wouldn't have been in this. But in all honesty, I probably would have broken even on this trade because I probably would have been shooting for the stars. But that's how I would re-enter. You have, you take out another supply zone here. What caused the supply zone failure? Something in here, so you get back in here. But again, this would be, I probably wouldn't get that because I'd take a pip and a half. But yeah, if you got a 6.4R trade And this is again where you guys got to figure out your management. Myself, I'd break even at 4R, and chances are I would probably break even on this trade. But that's how I would re-enter back in. If you're wanting to secure profits, I would do something like this. Soon as this was cleared, soon as that was cleared, you'd again just put your stop loss just down here somewhere. And then you're basically protecting your profits, right? So you could go stop loss there. Then we create another demand, we push higher. So what do? You put it under that demand. We created another high here, so you have a sort of a demand here. Then we go and create one more high. What do? You put your stop loss here, and you could even say you made one more push, so you trail your stop loss here. Now it comes back and takes you out. So in this case, you would be taken out of the trade at 4.5R. So that's a way of managing where you're guaranteed to get profit. And like, you know, even a 1 or 2R is better than a loss, right? But you just keep trailing your stop loss under the demands that put in the last high, if that makes sense. Let me just open my chat here, wherever that is. There we go. All right, so yeah, let's see, where did we get to? A lot of liquidity. Okay, we answered that. There's a chance for extreme. How can you confirm the sell? Okay, so I actually, for those of you that are in my free Telegram, I always usually show 2 entry possibilities. And the way it happens for me is, so I trade break of demand and supply, not break of structure. And the reason I do that is I look at the initial reaction point where we tap into the demand, and then it goes back up. And then what I'll look at is what took out the reaction point. Well, in this case, you could say this white candle or something in these wicks did. And your first entry would come from there. Your second entry is always the extreme. So probably something, I would say something in these 2 wicks would be the next area I would look at, because there's always shit in wicks. So the next demand that breaks, do you notice how there's not really much of an interaction? Like the reaction point doesn't stop and go back out. It just goes right through. So when I see shit like this, then you could be like, okay, well, it's the extreme of the leg, but you won't likely always have 2 entry areas. And sometimes you got to take this loss and get back in here. I'd say over half the time, it's what took out the reaction point, but then there's 30 or 40% of the time where it'll go to the extreme. And sometimes you just got to take a loss to get the actual position. What else did we have here? Can you go through order flow on the left chart so I can see why it was the last supply that worked? Right, so order flow for us, for me anyway, I'll be looking on the 4-hour, and where order flow started reversing is when this low here had a failed reaction and we failed to take this high. So this is like, it's not great structure because it didn't break anything, but I'll look at this as some kind of structure as it's a failed reaction. So as soon as this point got broken, to me, this point became weak and it'll get run and the bearish order flow continues. So that's how I look at it to start with. The next thing we do is we figure out where is the last leg down. Well, your last push sort of came from here. So as soon as that push happens, I'll mark EQ of the leg. So what's a valid supply zone? Well, to me, I'd probably look at this wick here. And then I would look at this wick here. And then if it breaks past these, we would look at the extreme here. However, if we ended up breaking all of these, the chance of this holding is a lot lower, as we're starting to develop a weak high at that point. But how you select a supply is a good supply should come from the premium if we're selling. Now, if this fails to reach premium and price starts going down and taking out demands here, as long as a 15 chalk is completed, it's worth trying to sell. It might take you out because it's in discount, or it might go. Most times it will come back in premium before selling, but every now and then it won't. So that's kind of how I look at order flow. Should chalk be on the lower low to the left? Oh, you're talking about this right here. So I don't consider this anything significant because this drive didn't actually take this high or this high. Whereas this drive here, where's my pen? So whereas this drive here gave us the last high. So I'll be using this as chalk. I don't need to use that for that reason. You just kind of look at your interaction, right? And you look at it here too. This is the candle on the 15 that gave us the new high. This wick really didn't do anything. This wick was more of a liquidity grab and a failed reaction. So when you see something like that, well, why did this fail to go higher? Well, the only thing I can think of is something like this. And you would look at it as stacked liquidity again. And the idea is just to try to build a narrative and not jump on everything you see. And like, I know in the real life scenarios, it's a little more difficult sometimes, and you do got to take 2-3 losses sometimes, but that's the reality of it. Like, I think it was Monday or Tuesday, I had taken 3 losses, and then I think my 4th trade finally went for me and put me up on the day. But that is the reality of the market. Let's see.
I have a question for you.
Yeah, go ahead.
Let the other guy ask his question.
Okay, go ahead.
Yeah. So my question was, if there's no change of, if there's no supply to demand, if there's no flip, but there's a change of character, would you enter at the extreme, or would you wait for some sort of flip to take place before you enter?
Depends if you're with trend or counter trend. Counter trend, you're gonna want more confluence. Pro trend, I don't really need a lot to enter. I'll try the first risky thing I see. So in this case, this would be counter trend up to 15 at the time, but pro trend 4 hour. So like I said, these 2 demands failing would be enough for me because we got that V-shaped recovery and because we got the bearish engulfing on the 15. And while we're on the topic, can you explain V-shaped recovery? It's just how price didn't stay there. Price quickly left that area. A lot of times that's a sign the BFIs are not willing to let price go higher. It's very aggressive down. So had price stayed here like this and then did this and that and this and that, I would not enter on one of these. I would wait for this 15 chalk to complete because it's a weak high. So anytime you got a flat top or a flat bottom, to me, that's a poorly formed bottom. And a lot of times they get run. Whereas if you see something aggressive like this, this is kind of a bad example, but a lot of times it'll look like a wick. And it's as soon as you see a wick, that's a good sign the BFIs are not letting price go lower. Just like a lot of times you see wicks, they swept liquidity, price goes the opposite way. You trade away from the sweep. So in this case, there's no wick, but price very aggressively came down and you get a bearish engulfing. That's still good enough for me. So I hope that kind of makes sense. What else got asked? Move your entry, and if you get, you tag, and if not, go for the next one. That is correct. Do you only trade off higher time frame POI? So yeah, so what, I'm pretty vague with that. So when I say 15-minute POIs, I will cycle through 10, 11, 12, and I'll go from 10 to 30. And I will look for POIs anywhere in there. And the reason being is sometimes 15 doesn't give you a clean POI, but most times, like even 10, 12, 13 minute, you'll find sell the buy wicks or something. And sometimes it's just a cleaner looking area. But yeah, when I say 15-minute, it's 10 to 30 minutes. That's my POI. I don't use 5-minute for anything. And I know a lot of you guys do, but what I'll tell you right now is a 10-minute POI. Often those sell the buy wicks end up being a 5-minute supply or demand anyway. It just, I find the chart to be a little less clogged on the 10-minute. And that's kind of what I look at. Like the odd time, if I can't find a POI, I might go down like 9 or 8 or maybe, but it doesn't happen often. I'm usually, in that 10 to 30-minute range.
Yeah, so my question was, it was actually about this.
Yeah.
Do you only trade within higher time frame POIs here, higher time frame meaning the 15 minutes. So here, like I noticed on your right side of the screen, so you have this red area is, I'm assuming, your 15-minute POI.
Yes.
Like the entry that you took, the one that you mentioned was only 15 seconds. It wasn't like within it. So so here, like my question is, what is the role of the POI if we're not taking an entry on the minute or seconds within that same exact POI? Like
Okay.
what purpose does it serve?
So the purpose is mitigation is complete, meaning we tapped into this. And so when the banks and the financial institutions took sells down here, a lot of times they take sells and buys. And the process of mitigation is basically selling off all their buy positions to get into more sell positions. So as this is tapped, they've been selling off all their buy positions. This is kind of a poor example because price didn't really stay here too long. But anywhere you see a price stick around for a while, like for them to keep price down here, they would have taken buys and sells, which means as price started going up, they're making money on their one side of the positions, then they're losing money on the other. So all the process of mitigation is to get rid of any of the other side of the positions. So the purpose of this POI is for them to come tap it and get rid of any buy positions they would have been holding from up here, either a slight profit, slight loss. And while they're heading up here, they're still stacking sell positions. So like the way a bank can take enough positions is to take buys and sells. The reason that happens is there's often not enough liquidity for them to fulfill their orders. Meaning if they want to take 10,000 lots of sell positions, there needs to be 10,000 lots of buy positions to provide it to them. So if those buy orders aren't there, they'll take both the buy orders and the sell orders at the same time and cover their own liquidity. And as prices going up and inching up, they'll slowly start getting out of their buys because they got the sell positions they want. So the process, basically the purpose of the POI is just to tap and mitigate out, basically saying we've completed our mitigation, we've dumped all the wrong side of the positions. So once this has been tapped and you start breaking demands down, you've mitigated your higher time frame supply, you're showing willingness to go down. And so if you see something like this and it just did it in the middle of nowhere, it didn't tap a supply or anything, I wouldn't take a trade off that.
Yeah, that was exactly my question. So for example, in this example that you just mentioned, let's say, for example, that the mitigation happened but the price didn't tap into your POI, you would not be looking at anything on the 1 minute or the 50-second, nothing, because your rule should be, you need to tap into like this institutional area, then you can take the positions, right?
Correct. So the way it once got explained to me is think of swing traders. Swing traders usually use their 15-minute as we use our 1 minute to enter. So where do swing traders get their entries? Off the 15-minute, right? So, and they probably have the highest hit rate out of any smart money traders because it's just lower risk. You just got to hold longer. But if they take their positions off to 15 minutes only, then it can be assumed that it's likely going to top the 15 to 30 POI before the true move. Like in their case, they would probably just cover this whole order block and assume that it's going down. If this one fails, they'll probably take the whole next order block. But in our case, we're like, okay, well, we tapped the 15, we're breaking ones, we completed the 15-minute chalk, we can assume that we're going down. So you're always looking for that higher time frame POI. Consider yourself as being in line with the swing traders and the banks off the higher time frame. Like if this happens in the middle of nowhere with no POIs, this is absolutely nothing to me, and I will wait for it to tap some sort of POI. And if I have to miss a trade or sit out a session, like yesterday I sat out, that's okay.
Yeah, and so basically, like, thank you first of all for your detailed answer. That was very detailed. So my last question to you is this. So for example, so when you said that you start breaking structure from that POI that you mentioned, the 15-minute one, it's basically you need to see the break of structure on the 15, not the 1 minute. That's how you confirm that the price is actually going down in accordance to your higher time frame bias.
Yeah, so counter trend, if you're safe, you want to see this 15 chalk complete. Pro trend, I would be more than happy to take it after just one demand fails. Like, say we were bearish at this point, after this first point would have failed, I would have been like, okay, I'm jumping in. But at this point, we're still not sure, right? So we want a little more confluence. And that's where you start looking at shit like, how did that top form? Okay, V-shaped recovery. Did we get an engulfing candle on the 15? Yes, we did. And you just start putting the pieces together as, is it high probability or not? And all these things come into play. Again, like if we didn't get this top formation the way we did and it was a flat top, I would not be okay with entering here. I would wait for this to complete. So all these variables come into play. Hopefully that makes sense.
Yes, it does.
Could you show possible buys today in the Samadhi buy? I honestly didn't see any of the charts. I'll be honest, I slept in today, guys. Was it in London or was it in London or was it in New York? Does somebody tell me? London, yeah. Okay. Let's have a look at London. So where would London be on this? So probably you probably pull this as some sort of POI here. Let's see if we can make something happen here. So this would be some sort of POI here. It's not a great POI, but it did lightly take this high if you just look at it. So if we put that on all charts, when you see shit like this, chances are this would be stock liquidity. For myself, yeah, you probably could say you look for an entry there and you might get taken out there. Let's see. Yeah, you could take the whole area. I don't know how many pips is that. If it's small enough. Oh, that's only 3.5 pips, dude. You could literally take the center of this. Like I would literally take the center of this, being that it's that small. I don't know what his buy is. I didn't see
the tiny refined demand on the 1 minute, like that one.
Yeah, so the only other entry I see for myself, like I don't trade like he does. I look at his charts and he trades very different than me. So I would look at something like this as a demand, and I would look at something like this as some sort of supply that failed. And to me, this is okay to enter on something like this because at the time you're somewhat pro trend, right? You're still kind of inching higher. And when I say you're inching higher, you still haven't hit that premium. And like, I honestly didn't see his trades, so I don't know what he did. For myself, I would be okay with taking just half of this, being that it's small enough. So like, if you get an area like this and you're, if it's small, like 2 pips or under, I'm okay with just entering here. If it's too big, I'll wait for a more refined area like this to enter. But yeah, I don't know. I probably can't break down his trade buddy as I didn't see it. But he probably was looking that price has not hit premium yet and that it should continue higher. I know I look at his charts and sometimes they make sense to me, sometimes they don't. To me, I'm a little more aggressive and I like Sketchy's charts and Blackwatch's charts. And it's definitely a little more aggressive way of trading, but that's what suits me. Yeah, and hopefully that kind of makes sense. But yeah, this whole block, half of it would be what I would be looking for a buy. And that idea would be based just on the fact that we're expecting to hit at least premium or above. Everybody's calling. Was there any more questions here before I go?
Rob, just one question.
Yeah.
You talked about inducement before a point of interest. So do you look for that on the 4-hour or the 15-minute?
I usually look on the 15-minute.
15-minute?
Yeah, sometimes 4-hour. Sometimes 4-hour won't show it that clean, but if you break it down on the 15, it will. A lot of times 4-hour just very aggressive moves, right? But on the 15, if we go and look, usually there's some sort of inducement under any OB, right? So if we look at the OB we tapped into, to me, this would be inducement. And as long as that inducement intact, we expect that to hold. Basically meaning that if had we taken this inducement and we made a new low, the next time price comes up there, I know there's a low probability that this OB is going to hold. But since this inducement got tapped in, we got a bit of a reaction, but we never made a new low yet. So until a new low is made, I expect this OB to hold. So that's kind of how I look at it, as inducement being burned up. If it got taken and it made a new low, say this got taken out, at that point we'd be like, okay, well, if price comes up there, chances are it's going to the next OB, which would be this one, and use this for inducement. So that's how I use it.
Okay, thank you.
Yeah, you bet. Thanks, but do you take trades when price is not near a POI? No, I need it to top the POI. Usually between 10 to 30 minutes. Most trades I can find a POI. If it just reacted in the middle of nowhere and it's a reaction to a 1 minute something or a 3 minute something, I'm not okay with taking that trade. I used to take all of those, and I found that I started losing a lot when I started using really low time frame stuff. So myself, I stick to that 10 to 30 minute POI. I know a lot of you guys trade the 5 minute. That's totally fine. The 5 minute ends up being 10-minute wicks a lot of the time, so we get the same POIs anyway. It's just my chart's a lot less cluttered. So hopefully that makes sense. Does anybody have any more or last questions before we cut this meeting short? I'm gonna get running pretty quick, but I don't mind answering a couple more if there is.
Rob, if price if price creates like a new lower high or lower low, but there's no inducement, so will the order block hold, or is it like less probable?
So annotate for me on this chart what you mean.
Sorry, inducement.
Just like annotate on this chart and show me what you mean, and then I can maybe explain it better.
So like this order, the first supply is when you have there's price basically after the move it creates some inducement, but the first one I don't see any inducement.
This one here?
No, the one like the price reacted off of.
Yeah, so the one, so when price reacted off this.
Yeah, so before like the push down, there was inducement, right? But the order block above that, there's no inducement.
You mean the order block right here?
Yeah.
Yeah, well, there is, because these wicks would be some sort of inducement. It's not the greatest inducement, but it's there. It hasn't been taken. Now, say the situation was a little different though, and we get something like this, where this wick came above and took all this inducement. Well, now I'd be looking at that, I'd be like, well, there's barely anything there. Liquidity's been swept. Whereas this, in this case, it's still intact, right? You got to look at these wicks. If this wick came up and took that, the inducement's gone.
All right, makes sense.
The idea is like, this isn't the best inducement. What I like to see is, say price is going up. I like it to come back down, drop inducement, and then come down and tap this demand. Like my favorite inducement is this kind. When it's just a wick, it's a little harder to read, and that's where you got to look at all the wicks in the range. I'm like, did that sweep anything, or are all these wicks intact?
Okay.
And what time frame is that? The one that you just showed in your example? 15 minutes, I assume?
Yeah, exactly. Bro, wouldn't you refine the 15-minute POI to clean POI like 7 to 15 minute when it's refined the clean 7 or 10-minute POI isn't really tapped, right? I'm not sure what you mean, but it's the exact same on the 10-minute here. Your inducement's still intact. So as soon as you grab this inducement, which we kind of did here, and then you grab some more here, there was failure to make a new low. Had this new low been made, this inducement would be burned, but we just kind of reacted and we kind of stayed in this area. Now we made a new low. So if price came back up here now, I don't expect this OB to hold. I expect it to come to at least this before we see some sort of real reaction, if that kind of makes sense. The theory doesn't always play out, but more often than not, it will. For those of you that are in Phantom, Sketchy goes over this with Albie in one of the Zooms really well, and he basically explains it as the inducement's intact as long as the new structure hasn't been created. But if new structure's been created, that inducement's been burned up and used as fuel. So hopefully that makes sense. I'll do one last question if anyone has one here, and then I'm going to get running, guys. And again, like I'll put this up on YouTube for anyone that wants to rewatch or anybody that did sign up and missed it, obviously. Does anyone else have any questions? If not, then that's totally
quick
cool.
question.
Okay, yeah, what's up, buddy?
You said that when price taps into liquidity, it goes the opposite direction, right? So why does it go in the opposite direction?
Well, you're hitting all those stops. You have all your stops sitting here, right? So
Yeah.
as soon as you wipe these stops, you're gonna get some kind of reaction, and those orders get filled. You always get some sort of reaction the other direction. Same thing here. What happens when price hit right here? You kind of started wicking. Why? Because there's a bunch of stops there.
Okay, okay.
Yeah. And that's even right here when we took this 4-hour low, what happened? You started getting a bunch of wicks. There's some kind of reaction, right, to all the liquidity. And more often than not, we'll see some sort of a pullback, whether it comes down a little more or it comes back on Monday, but there should be some sort of a pullback after wiping a 4-hour zone. Most times there is anyway. But even if there isn't a pullback right away, you have liquidity here still in the form of this wick. You have this. So
Yeah.
my expectation is for one of these wicks stacked is some sort of demand and get a reaction from. If it doesn't get to that, then one of these will, but you will get some sort of a pullback as there's lots of resting orders there. You got to think of institutions, they take their orders and they hold them. And this wouldn't be like your huge institutions because they know where to get out. This would be probably your smaller hedge funds that don't have the kind of information the banks and stuff do. Like the banks know what the news that are going to be announced are ahead of time. That's why they're on the right side of it. That's why they can spike price whichever way it has to go. It's all predetermined. Whereas people like us just have to try and ride their wave. And people will always be like, well, they're doing stop hunts and they're looking for retail traders. No, they know where liquidity lies and they're not wanting your money or my money. They're going to take the small hedge funds money because that's actually worth going after, right? Whereas you, I, and every other retail trader in the world account for between 3 to 5%. We're not worth going after. So they're definitely not so much as stop hunts as much as the algorithm knows where people put their stops. And smaller hedge funds use stop losses when they trade. They have to, otherwise they'll wipe their accounts. Somebody like JP Morgan, they take positions with no stop losses. Reason being is they have the ability to be $500 billion in drawdown because they're a liquidity provider.
Right, right.
That's kind of how I look at it. You're welcome, guys. We'll end this one here. I'll announce another one of these next week. We can do another one and go through some more questions. Some of you already signed up for the back testing session. I'll see you there. If you're not, definitely sign up and we can go through some more of this stuff while we're back testing. And aside from that, yeah, have a good weekend, guys. And I'll see some of you on Sunday and some of you next week's free Q&A. And again, this will go on YouTube for anyone that wants to review. I'll drop a story when it's uploaded. Have a good weekend, guys. Thanks for coming out.
Thank you. Thanks a lot.
You bet, guys. I'll talk to you later.